Okay, it looks like we're live here. Great to have you guys all here. I'm Rob Tetrault. I'm head of the Tetrault Wealth Advisor Group. I almost said host of the Running Journey podcast because I've been saying that a lot lately. I have Adam Hague with us today, Chief Investment Officer at the Tetrault Group. Adam, great to have you here. Thanks for joining us today.
No, thanks, Rob. Looking forward to chatting with you.
You're like, I don't have a choice. You asked me to be here. I'm here.
No, I always love talking about markets. So.
Yeah, you do. And I love that about you. Those that don't know, Adam is about, I don't know, I think you're in your second year here or been about here about 2 years. So background CFA, which is a chartered financial analyst. About 20 years in the equity market, something like that?
Yeah, it's been a long
time. Been doing this your whole life. You started when you were 12.
We can say that. We can pretend that, yeah.
So very knowledgeable, very happy to have you on the team. You've dramatically changed, improved our business processes, and I'm so happy to have you on the team. And the clients are benefiting immensely from having you on the team. So I'm glad you're here. Glad we're chatting markets today. Did you watch the hockey game last night, Adam?
Unbelievable. I think everybody watched it. What a game. What a finish too. Unreal.
We got them. We got the Americans on this one.
No, we needed that one for sure. That one felt.
How good is Connor McDavid right now?
I just can't believe how open he was in the slots. Like, geez, what an unbelievable play. Unbelievable player.
Maybe you want to watch the best human being on the planet at hockey. The guy who's the best hockey player on the history. Like right now, maybe you want to watch him in the slot in overtime. I don't know. Americans. I think that was Austin Matthews who missed his guy. He chased in the corner and he should have been watching his guy. That was fun. That was really fun.
What an achievement for them. And speaking of achievements, I know you are pretty modest about your running, but I'm not sure if you want to tell everybody about the 7 marathons in 7 days.
Great transition.
Great
transition, Adam. Yeah, I had a blast. I was on vacation-ish last week or 2 weeks ago. I ran 7 marathons in 5 days on 7 continents. I ran a marathon in Antarctica, Cape Town, Africa. I did Perth, Australia. I did Dubai. I'd never been to Dubai. I'd never been to Perth or Africa or Antarctica. Then I did Madrid, Brazil, and I finished in Miami. It was a blast, Adam. It was so fun. I'm so glad I got to do it. Like a bucket list type event for me.
Favorite leg? Did you have a favorite leg?
I mean, Antarctica was special, but honestly, I could have been in like northern Manitoba running a marathon. It was just white everywhere and just snow everywhere and the sky. But Dubai was something else. It was like there's money there for sure.
A little bit.
We are giving everyone a chance to get there. As you guys know, this is a live, which means you can ask questions. You can go in there and ask questions, post your questions in the comment wherever you are watching. If you're watching on YouTube or on Instagram or TikTok or Facebook or X. I think I got all of them. Wherever you're watching, please put your comments below. I do have clients have emailed me questions as they have a habit of doing ahead of these things. I typically get questions from clients. Maybe I'll start with a softball one for you, Adam, just to get things going here. But what's your take just generally on what's happened recently? And maybe we just want to start with that. Like, how do you feel about this market right now?
Yeah, it's a really interesting market. It's really interesting times. There's always there's a lot of stuff going on and things are happening really quickly with our friends in the United States. And then there's political situation right now. Trump is very high profile and he stirs up a lot of emotions for people, which is understandable, both positive and negative, which is not something, that's something we are always striving to avoid. We try to keep, our emotions and our political beliefs just completely separate from our investment decisions and our analysis. But yeah, really interesting times, lots of stuff going on.
I like how you touched on emotions because emotions, it's what drives the market, right? Emotions, fear and greed, it's what drives the markets. And fear, some people, there's could be potentially a lot of fear right now, but there's also a lot of greed right now. And I've said since the beginning when I started this business that my job would be to be like a proper asset allocator to help our clients with planning and to make absolutely sure that we remove emotion from the process. We focus on logic, we focus on metrics, we focus on multiples, we focus on asset allocation, we focus on reducing risk, building the right portfolio for every client. And like, I've always removed emotion from a process. And I think that's one of my greatest skills, I think, is removing emotion from the process. You're unbelievable at it too. So I do think it's good for clients for sure.
Yeah, no, I think that's one of the most important parts of investing, right? We get our information from different sources, and in the media, their goal is to get your attention, and one of the best ways they can do that is by stirring up emotion in people and presenting you with facts that might make you feel uncomfortable. And so we have to eliminate those things and focus on what's really happening, not just what we're seeing in the media.
Okay, so I'm going to start on the currency, on Canadian dollar with you. We'll handle this question together, both of us.
Sure.
And then I got a chart here that I want to share. Actually, you know what? Let's instead start with the kind of the lay of the land right now with respect to the market. So I'm going to pull this up here and I'm going to share my screen with you guys. This is the chart I want to share. I'm going to present. Sometimes I feel like my dad. I can do this. I can figure this out. Share screen, obviously. Rob, you can do this. So this first one that I'm going to share with you is just the phase of normalization. I'm assuming, so kind of what phase are we in right now? People think, where are we in the market? So these are 5 indicators. I'm just going to share with them to start this thing. Market volatility. We're below historical average right now, right around 17, 18. Yep. This is often measured like with the VIX, the volatility index. The max has been 60. That's when people are freaking out and the market's down 40%. The minimum is 9. That's usually in good times, right? When there's no market volatility, it's usually the market's in a good space. Nobody's thought about the stock market for a while. Next thing you know, you're looking at the news and it's an all-time high.
Yeah, nice.
That's not quite what we're seeing now, right?
No. There's a little bit more volatility, just with all the things we were talking about in the news. Yeah,
we are still kind of at or around historical average. 10-year treasury yield, if we look at the last 60 or 70 years, right around kind of the average of what we've seen. So just to put that into perspective, the US 10 and 2-year relationship, this is like the inverted yield comment. We are within normal range at the low end, so kind of on the inverted side. Maybe you could just touch on what that means real quick.
It's not inverted right now. It's slightly positive, the 210 spread, but traditionally that's been like when the yield curve has been inverted, that's been a sign of recession. That hasn't really held up lately in the last couple of market cycles.
Yeah, it's over the last 2, or it's 1 for the last 3, or 0 for the last 2.
0 for the last 2. So it doesn't necessarily mean that we're going to get into a recession just because the yield curve is inverted. But right now it's positive, that spread.
And just to clarify, inverted means that the 10-year yield is lower than the 2-year yield. Historically, the longer you lend money to someone, the more they will pay you. But when your curve is inverted, it means you're getting more for short money than you are for long money, which is usually a sign that there are problems on the horizon, right?
Yeah, exactly. It's you can think of future interest rates as projecting future cuts, and if investors are projecting a bunch of cuts in the future, that usually means that the economy would be in trouble and that it'd be in a recession. So being positive right now is a good sign.
Yeah, economic indicators. I'll just cover 2 quick ones. These are American, obviously US CPI, that's consumer price index. So that is effectively inflation, kind of right in the wheelhouse of where the US Fed wants us right now, 2.9%, a tad on the high side. But like, if you look at the chart here, it is exactly the median of the last 75 years. So,
yeah, and it feels a little bit high because it has been low for the last decade. But when you put it into a longer context, it really isn't that high. And the Fed is trying to get that down to 2%, and they've slowed on their rate cuts, but I think they're just waiting to see how things play out.
Yeah,
a little bit.
And the last indicator here is unemployment. In Canada, we'd be kind of right in the normal range. In the US, they are below the historical numbers for unemployment, so strong job growth, and like they measure a little differently than we do, but 4.1, that is a low number.
Very low. Yeah, things keep ticking along, and the U.S. economy keeps performing really, really strongly.
Okay, so now I want to pause and I want to ask you about. I do see that there are questions coming. You know what? Maybe I'll start with. I think I want to start with an American currency, like a currency question. So I'm just going to find that slide for you right here. What's your take? What is our take on currency, on the Canadian dollar, and what that looks like kind of long term? Well, not long term. What's your take on the Canadian dollar right now relative to like purchase parity and stuff like that?
Yeah, well, I mean, the dollar has been under some pressure, and you know, we are getting a lot of calls about it. Um, you know, I can understand that. Really, what I think has been driving the pressure on it is just the interest rate differentials. With the Bank of Canada has been kind of leading the pack of central bankers in terms of rate cuts, and because the U.S. economy has been performing so strongly, you know, they've slowed down on the rate cuts, which you know has put some downward pressure on the Canadian dollar. But I mean, you have to look at multiple factors. You have to look at the whole picture, right? And purchasing power parity, it's an economic concept that kind of states that, you know, things should cost the same in no matter where you are in both markets. So when you factor
Let's pause real quick. Let's pause real quick. I want to
Sure.
explain that concept because I think it probably is a little for you. You know, you've been doing this your whole life, but so let's imagine a purchasing power equation. So the purchasing power parity. So let's say let's say a Big Mac or a basket of goods in Canada, or in the US is $1. We'll use that as a staple, and it's $1.25 here, right? Something like that. Um, so in other words, or maybe it's slower, but regardless, your exchange rate. So let's use $100. Sorry, $100 for a basket of goods in Canadian dollar, and that basket is $80 in the US. The purchasing power parity exchange rate would be 1.25. So in other words, 100 divided by 80. So if your exchange rate isn't that, that means if it's higher, that means, you know, you're less favorable. If it's lower, it means it's more favorable. So that's how they measure this. They measure a basket of goods in your currency using the exchange rate. You know, is it cheaper to buy a Big Mac in the States with USD, or is it cheaper to buy a Big Mac in Canada with CAD on a relative basis? Did I form that?
Yeah,
did I say
that
that well?
sounds about right. And yeah, please stop me again if I start glossing over some of these concepts that might need to be explained a little bit.
So how is the Canadian dollar right now relative to purchasing power parity? There's a chart here, and I pulled it up, and hopefully you could see it.
Yeah. So like we were talking about before, the dollar's been under some pressure, but that makes our exports, and it makes the products that we sell more attractive. And it's not a perfect concept, so sometimes we overshoot. And right now, if you look at the two currencies and you look at the two economies, the dollar is 16%, or sorry, I should say 16 cents below where purchasing power parity would predict it would be. So that's going to make things look for our exports are going to be cheaper, and it's going to make our markets more attractive and sort of put a floor under the value of the dollar relative to the US dollar.
I like how you say that, put a floor. And that's the best way to say it, is that, I've had the question, is our dollar going to 40 cents, Rob? Is our dollar going to go to 10 cents? Is this possible that this happens? And I say unequivocally, no, that is not happening. That will not happen. Why? For a whole bunch of reasons. But like, we have these goods, we have purchasing power parity, which is totally undervalued right now. We have all these commodities that are attractive to foreign buyers, and we do have a floor. So if there continues to be negative pressure on less buying with respect to exports and tariffs or whatever it may be, we still have an opportunity to sell our natural resources, our goods, to other sellers, and they will be attractive, right? If the dollar goes down to 65 cents, like, that would test kind of long-term lows. But the last time the dollar was at 65 cents, like, we had oil and commodity prices were extremely, extremely low.
Yeah, exactly.
We are a petrodollar at some form, right? So the more that we have appetite and demand for our oil at $70 instead of $10 or $20, the more that props up our currency, right?
Yeah, no, and I like how you pointed out how much commodities and oil and energy that the commodity that our market has to offer, because those are things that everybody wants. They're commodities, they're global markets and stuff. And while it might take us a little bit of time to find other buyers, at some point, the dollar, if it gets cheap enough, it's going to overcome all those barriers. And that's, again, goes back to just putting a floor under it. And there's just some natural support to the dollar's value.
Yeah. So that's kind of I'll show this question here from Nolan. He's asking about resources being landlocked. Who do we sell to? Does it not crater the currency? So short term, it's possible that you get some currency devaluation based on tariffs, I think is the question, right? There's no hiding that point. That could happen. But our resources are valued globally, and not just our resources. We export a whole bunch of other things that are extremely valuable globally. And our basket of goods is already undervalued by about 16 cents. So, there's appetite for it at certain price, whether it's through Europe or whether it's through, other buyers. I don't know what your take on that is, but do you want to address that question?
Yeah, and I mean, when you hear about our resources being landlocked, I mean, that's what's in the media again, primarily, and that has to do with oil and pipelines. But, we do have other ways to transport oil. We can transport it through rails and get it to ports, maybe not as efficiently as with pipelines and stuff. But we're also selling other, valuable commodities like potash, copper, things like that are also going to be very, very attractive to foreign buyers if the dollar, is weak.
They convert their currency into Canadian dollars and they buy our commodities or our products. So that means there's a bid, there's buying of Canadian currencies, which is why those commodities prop up the Canadian dollar, right?
Exactly. Yeah, exactly. And so there's, Canada is a very big country with a diverse, what should I say, basket of resources to offer. So it's not just oil, it's other things. It's other things as well.
Okay, good. I got a question here from Carl. It's a bit of I'm going to show it. I'm going to let you address it perhaps, or maybe I'll address it. Is there a chance the U.S. administration could escalate and freeze Canadian-owned USD accounts or U.S.-held equities? I mean, maybe I'll start, or do you want to start?
No, you go ahead.
I think there's a lot of fear right now. There's a lot of fear out there, and there's, I guess, reason to be fearful, but I don't think this is happening. And to me, this is not a rational fear. So yes, it's important to consider all options, and we do consider all options, but like Canadian-owned USD accounts, like that'd be impossible. Not impossible, but like, what do you like? How would they even? I can't see that happening.
No, I don't think that's something on the radar. The rhetoric, it's fairly new. This sort of Canadian-U.S. economic friction, I guess I would say, potential friction. But, we're still going to be neighbors in the long run. And even if it is a slight sort of puts a little volatility in the relationship, I don't see any moves like that being in the U.S. interests, for the relationship in the long term. I don't see that on the radar.
Agreed.
Yeah.
Clarification question for Rodney here. Basket of goods 16 cents lower. Yes, this was a U.S. comparison purchasing power. I believe the chart we had was a U.S. purchasing power parity equation to the U.S.
Yeah.
On a whole, globally, that would be a different equation because you'd want to have one with Europe. You'd want to have one with the Australian dollar. Like there's a different equation for each country, Rodney. And that is a good question. Keep the questions coming, guys. I do have some that are coming in via email, and I'll address those, but please do feel free to send the questions coming. We're here to answer your questions. I'm going to share this one here. It's just a lay of the land with respect to, this doesn't mean much, and we don't look a ton into this, but there are, if you look at January was a positive month. A good start to the year historically has meant a strong rest of the year. The January effect, you may have heard of it. We would never manage money strictly on this, but it is nice to see that a positive return historically has meant an average of 12% return for the rest of the year with only 5 negative years. and a median return of 9.7. So 76% of the time higher. So 84% higher on an average basis. So that's, hey, it's a nice sign. I know you're not a guy who would put any eggs or all of your eggs into this, but I just wanted to share this to remind our clients that although we can feel jittery, like we've kind of seen some of this before, right?
Yeah, no, I like that, actually, feeling jittery. But when you look at the data, the market continues to perform, and the economy continues to perform, even though we're feeling jittery.
Yeah. So let's talk about the economy. I did get a question here about tariffs and a potential impact on GDP. So basically the question is, and maybe Diego could write it in here, but is what would be the impact of tariffs on Canadian GDP? So do you want to start addressing that? I know we don't know the answer, but maybe we could at least address it.
Sure. I mean, I see all sorts of forecasts, and I would say the majority of the forecasts are estimating, the short-term impact. It could be about 1 to 3% of a hit to GDP. But again, there isn't much precedent for this, so I don't think we know exactly, how it's going to impact GDP. And I do see some projections that show, real economic growth in Canada improving over the course of the next year. So, yeah, I think Canada grew at around 1.5% last year, and the IMF is projecting about 2% growth next year, even with all this tariff news factored into their forecasts. So, I think 1 to 3% is a good baseline. I would say, we don't really know if it's going to be that negative.
Yeah, and that's a 1.3% impact on GDP. So this chart here, source is a Bank of Canada calculations, estimate, projection. Someone from our team put this together. This kind of highlights the kind of 1 to 3% range that you talked about. It shrinks pretty quick though, because by year 3, it's actually there's no impact, because what happened is, if there are permanent tariffs to the tune of 25% applied across the board, which again, we don't think will happen, but if it does, Canada, our country, our economy, our sellers, our manufacturers will find other ways to sell their product. And that's why by year 3, there's, the impact is kind of erased. So yes, it would suck short term, but I mean, think of like COVID, or think of, 9/11 or the tech wreck, or the crash in 87, or, the inflation crisis in 81. And we saw much, 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 much worse impacts. And sure enough, the market recovered and generated double-digit returns on average over the last, 70 years or whatever. So just perspective on that, Adam, if there's anything you want to add to that.
Yeah, I mean, like we said, there is probably going to be some short-term impact. But, our government, our politicians, and our businesses, they're going to react to tariffs if they're implemented, and they're going to look for other markets to sell their goods in. It could stimulate, some investment in infrastructure to get our goods to other markets and stuff. So, while it is going to change our economy and probably have some drag in the short term, we could end up emerging, stronger with a more diversified economic base.
I'm going to share 3 or 4 slides here on this exact topic with you. And this one talks about animal spirits being unleashed and trade policy. So you touched on this. Is it showing up there?
There's nothing up there yet.
There's nothing up there yet. Okay. Why is it not there? I can do this. Everyone. Come on, Rob. You can do this. This one. Okay. So there, we talked about average tariff rates. Maybe the slide on the right here looks at the last 130 years. What has happened with tariffs? Duties collected as a share of total U.S. imports from the U.S. So they were at 30% in 1900, and they've gone down progressively to the single digits that we see now. The threatened tariffs, whether it's 25 or 15 or 14, whatever, what's that? But what does that do to? I guess I'll let you speak about these slides. Sorry.
Yeah, I can't see the slides that you have. Oh, there we go. Okay.
Do you see them now? The one on the left is the Small Business Optimism Index.
No, sorry, I'm looking at the animal spirits and stuff. And so, yeah, trade policy, it will have some impact and stuff, but you have to look, the trade policy right now, it's mostly rhetoric. There have been some tariffs implemented, but a lot of it's all talk right now. And so we have to, look and see what's actually happening in the markets. And, what's actually happening in the US, there is a lot of cutting going on, I guess, to government services, and with Elon Musk and his Doge department. They've found a lot of savings in U.S. government spending, and regardless of how you feel about that and how fair it is, usually what that would mean is what I take it is Trump's looking for a way to cut taxes.
The end impact
in his last term. Yeah, the end impact would be him cutting taxes. And so something like that would be very, very stimulative for both the economy and equity markets.
Well, if we go back to
stimulate animal spirits, for sure.
Yeah, and that's the chart on the left here, Business Optimism Index. So businesses are excited that this index proves that businesses are excited because they think that there are tax cuts coming. They think there are efficiencies coming. They think that this will lead to, and that's why the market is, I would argue that's why the market is plowing right through this uncertainty, because it's like, wow, this is going to be great for businesses. It's going to be great for profits. It's going to be great for the stock market, right?
Exactly. Yeah. No, there is a lot of stuff going on that's supportive of the market, deregulation,
volatility. This chart talks about volatility. Our view on that, obviously, is that there could be some volatility here. I don't want to paint a perfect rosy picture for anyone here. There could be some volatility. We saw several spikes in the last 12 months of volatility. Every time we did see a volatility spike, like late July, early August, we saw kind of that freak out. And it was a very short-lived freak out. Was it 10%, I think, in a week, something like that?
Yeah.
And the market just came right back. And then in December, we saw something similar. I don't think might have been another 10% or so in December. So there will be more volatility, and it wouldn't surprise me if we saw kind of something maybe a little more. Like, that's not off the table that we would see like a 15 or a 20% kind of risk off, where it's kind of potentially short term and some of the flush out some of the uncertain investors, right?
Yeah.
That's my dad would call that healthy for the market. He would say that's healthy to flush out the uncertain investors, the ones that maybe shouldn't be in equities, right?
Yeah, for sure. I mean, anytime there's more uncertainty, it's going to lead to some volatility as the market digests the new information that's come out. But generally, as things have been processed and people realize that, it's the way things are going to end up is probably not going to have a negative impact on the economy, or not have necessarily the impact that they expected, markets have tended to rebound.
Here's a chart here on the growth forecast for our Canadian economy. You touched on it earlier. If I would have been on the ball, I would have popped this slide up. I would have been really, tech savvy. I would have popped this up. But now I'm popping it up after you spoke about projected real GDP growth. So this is projected real GDP growth in Canada. Do you want to touch on this? 24-25. It's going from 1.5% to pretty much 2%.
Yeah, I mean, there has been a lot of negative news over the last few years about the Canadian economy, and the dollar, like we talked about earlier, has been pushed down a little bit. But those, once we get through that, we still have, like we talked about, a very diverse economy, lots of resources, highly educated workforce. It's a good place to do business, and so, despite all of those negatives, the IMF is projecting Canada to do quite well over the next coming year. We have a new leader coming, and that's probably gonna deliver some certainty into the policy path going forward.
Let me pull up that slide. We have a slide on that, Adam. Yeah. Let me pull that up. There's a slide. I have a slide here on policy uncertainty is uncertainty, but a potential for a new government is definitely positive for the medium term. You want to talk about that?
Yeah, I think so. I think, over the last probably like 6 months, there's been a lot of uncertainty around the political situation in Canada, and who's going to be, both the leader of the Liberal Party and the leader of the country. And like we said, anytime there's uncertainty, it leads to maybe some volatility in the market, maybe a little bit of weakness. But that's going to go away, right? I think Mark Carney's pretty, he's emerged as a strong favorite in the Liberal leadership race. And then eventually, we'll get an election, and, we'll know who the leader's going to be, and we'll know what the policies are going to be going forward. And again, I don't want to get into the politics too much, but I don't think Prime Minister Trudeau and President Trump had a very positive relationship. And so, I think, once we get somebody new in there who's probably a bit more business friendly, relations with the U.S. could smooth out a little bit, I would say, which is another positive.
Yeah, I think the key here is uncertainty, right?
Yeah.
We've talked about it at length, and if you have listened to me, uncertainty is not good for the market. And
Definitely.
There's been uncertainty with the relationship. And again, we're agnostic to politics. It's not our job to opine on who should run the country. Our job is to build portfolios based on what's happening. So you said it, our belief is that, regardless who gets in, if it's Carney or it's Poilievre or whatever happens, it should be a little more business friendly, and hopefully the relationship with Trump will be a little better, perhaps, and that'll eliminate some uncertainty. So a little less uncertainty is always good for the market. So you were speaking about I had you talking about real GDP growth, and we were talking about interest rates to boost residential, but I'll put a pause on that real quick. And I want to ask, or maybe I want to just discuss, maybe I want to tell people how we manage money and why it's important when you're facing. So now we've just kind of talked about this for, what's happening in the US, what's happening in Canada, what's going to happen to the dollar, where we're sitting at. But I want to talk about what we're advising our clients with respect to their own risk tolerance and how they feel about their portfolio. And maybe I'll just start by making a statement here. My belief as a portfolio manager is as a fiduciary and a steward of your wealth. So my job is to protect your wealth and to make sure I'm building a portfolio that you can sleep at night, you, the client, can sleep at night, and we're getting as many tax efficient returns as we can based on that. So you guys know I've talked about this at length in the past. I believe that we should own alternative assets. I believe that we shouldn't just own stocks. I believe that we should own some private debt, some fixed income, some private real estate, some infrastructure, some farmland, diversify as best we can so that if something does happen with the stock market specifically, we have real diversification, right? Real diversification is when an asset class doesn't move lockstep with another. So if you own Canadian stocks and US stocks, you might think you're diversified, but you're not really, because if the S&P is down 30%, the TSX is going to be down close to 30%. So that's not real diversification. Real diversification is uncorrelated performance of different asset classes. So if you own some alternatives, some stocks, and the stocks are up 30, the alternatives are going to be up there 8 or 9 or 10 or 11 or whatever they do. And if the market's down 30, they should do about the same, right? Regardless, 8 or 9 or 10 or 11. That's real diversification. And that's what we preach. So backing the truck up here with respect to this volatility, my belief is that this is a long soliloquy, Sorry, Adam. I let you speak at some point here. My belief is that you should not make asset allocation changes to your portfolio on a hunch or in a way to try to time the market or in a way to try to think, you shouldn't do that. Your asset allocation should be your asset allocation. And there's a reason that it should be your asset allocation, because that's your risk tolerance. That's what you're able to handle. And that's kind of what your life has taught you about investment. So when you become a client of ours, we take you through that. We look at what you own, and we adjust and we build an asset allocation model for you, on a custom basis. So if you are unhappy and you're not sleeping at night and you're starting to have impacts on your health with respect to your tolerance for risk, then that is a reason to change your asset allocation. Unequivocally, we should change your asset allocation. You need to call us and tell us how you feel if you're a client. But if you're just trying to time the market and do it on a hunch, that's a bad idea. That's a bad idea to say something like, you know what, these tariffs, I think I'm going to go all cash or partly cash, or I'm going to sell my growth stocks, or I'm going to load up on whatever. Like those ideas, they don't work, period. I've been doing this a long time. You've been doing this a long time. We know that human emotions get in the way, and that becomes a portfolio where someone's, next thing you know, they're out of the market for a year or two or three because they've made the wrong call. Now what? How do you get back in? So it's not what we preach. It's not what we believe in. Do you have a comment on that, Adam?
No, I definitely agree. If you are uncomfortable, like you said, if you're having trouble sleeping because you're worried about the market, that might be a reason to change your asset allocation. Maybe your risk tolerance isn't quite as high as it was, when you first invested. Maybe
And
something's
that's okay.
changed, and that's
That's
fine.
okay. Yeah.
So that is a reason to change your asset allocation. But trying to time the market, trying to time equity markets and buy at the low is nearly impossible. And I would say the same thing, Rob, with regards to currencies, right? Like, there's a lot of talk about the strength of the US dollar and worry around the strength of the Canadian dollar. But like we were talking about before, there is kind of a floor underneath the Canadian dollar, and these things are very, very difficult, and it's very dangerous to try to time them. So, I would say don't try to time the equity market, but also don't try to time the currency markets.
Yeah. So what do we do with respect to currency for our clients? And I mean, we've talked about, if you're a client, you probably know, we believe that, although we do believe that there's a risk that the Canadian dollar, gets further negative pressure. We think that's a very real risk. We also believe it's possible that the purchasing power parity equation evens itself out, right? So there's two there's two pressures at bay here working on the portfolio, and it's our job to monitor that, to figure out, okay, does client need Canadian dollars or US dollars in their life? First off, right? Are they living in Canadian dollars? They're living in Canadian dollars, right? Well, that's our barometer to start with, right? So yes, we want to own US equities. Absolutely, we want to own US equities for a portion of your wealth, but there may also be a portion of Canadian equities too, right? For income, Canadian income, US income. So I guess the answer is everyone's different, but it's part of what we do, right? We will manage that. So if there's an extreme oversold correction on the Canadian dollar where we think we're way out of whack, we will make a play or a trade to benefit our clients. And if it's the reverse is happening, right, the Canadian dollar is extremely overbought, we would do the same thing. So did I phrase that properly, do you think?
No, I think that's a good way to put it. And I would also point out that, most of the companies that we invest in, whether or not they're in the US or the Canadian companies, are global companies, or they're participating, in global markets where, a lot of their revenues are going to be in other currencies. And that is going to support their stock price, because as they're translated, their expenses are in Canadian dollars and revenues in American dollars. Any weakness in the Canadian dollar is going to increase their profits when they repatriate that currency, right? And so it's going to support their profits, and it's going to support their share prices. So you have a little bit of a natural hedge by investing in these global companies as well.
Yeah, and for every piece I see telling me on BNN that you need to stay away from Canadian investments, there's another one by some sort of investment guru that's saying now's the time to be buying Canadian investments because they're undervalued. So remember that what you are reading, right, what you're reading in the media is click baiting, right? They're trying to get you to read the article. They're trying to get you to watch the video or whatever they're trying to do. So take that with a grain of salt, right? If there's no, like, what are they trying to sell me here? And then I would be careful to form an opinion based on that.
Yeah, I mean, everybody has their perspective, and everybody is running their own strategy, right? And so sometimes those people are talking their book, talking up the way they're invested. But I think it's more important to just focus on, like you said, diversification across markets and economies. But we also try to have diversification by having multiple sources of return, especially in your equity portfolio, right? Things like being invested in semiconductors has worked out really well over the last couple of years. The GLP-1 drugs, that are being developed to combat obesity in the States, that's another, source of return. Increased defense spending, those are all sources of returns that are fairly well diversified from each other. That I think is going to protect you in the long run.
I'm going to show a question here from Carl. Do you forecast growth and opportunities in private debt investments as the Canadian government continues to encourage Canadian manufacturing and new business startups within Canada? Yes, I think is the answer. We expect growth there, but I'll let you touch on it if you want.
Yeah, no, private debt's becoming a more and more popular asset class, especially in Canada. Just the way or I shouldn't say capital markets, but the way our financial system is structured, it's very, very concentrated. The big six banks are very dominant in banking and lending services, but they have very similar risk tolerances, and they're targeting the same companies, and that's left that's created a lot of opportunities for some of these private lenders and private capital providers, to step in and provide, more customized solutions that is only going to, improve the Canadian economy, improve our businesses' access to capital, and I think that's going to have a really positive impact on, especially productivity. I do think private debt is going to, grow as an asset class in Canada, and I think it's a positive.
You talked about productivity, so I'm going to show a slide here on that. Key drivers of economic growth. I think you were just talking about productivity growth.
Yeah, productivity is a huge factor in the economy and in markets. And over the last decade, we've heard fairly negative things in the media about Canadian productivity overall.
Yeah, there's a slide here on that right here. Labor productivity. It's on the right-hand side here. It shows Canada kind of decreasing relative to the US. Go ahead.
Yeah, and those are, that's an economic-wide thing, but our great market strategist, Martin Roberge, is pointing out in one of his recent talks with us that productivity of publicly traded companies in Canada is actually really strong right now. When you look at their revenue per employee and some other measures that are applied, more to public companies, it's kind of taking off as our companies compete more and more globally. The ones in the TSX 60 especially, are doing really, really well. And I think that's another good sign for Canada, both the market and the dollar. Yeah,
and here's a little chart here. Slowing population growth, but obviously offset with improving productivity growth in 25, 26. So this would do, so your GDP growth is basically your population growth plus your productivity growth, right? So if you get more population, you get more GDP. If you get more productivity, if I'm able to, export at 1.1 units of productivity next year versus 1.0, well, that's 10% growth. So some sectors are losing, some are gaining. Overall, it's an average, and that's what you get. So that is your GDP growth. So in Canada, it's a combination of population growth and productivity growth. But over the future here, 2026 especially, Martin Roberge would agree, it's going to come from productivity growth.
Yeah, I think so. And there's going to be a little bit of a slowdown in population growth over the next year while our immigration levels sort of normalize. But I think over the long term, we're going to continue to add to the population as well, which is going to support, both GDP and asset prices.
You wanted to talk briefly about China. I put this slide in here for you. Do you want to touch on it quickly?
Oh, yeah, I did. So, yeah, China is a really, really interesting economy and market. There's been a lot of news about their housing issues. It's quite a complicated situation. They have an extremely high savings rate, and they're persistently running trade deficits with their trading partners. And what's driving that is sort of a low level of consumption in their economy, a low level of personal consumption relative to other economies. And so, Chinese consumers aren't consuming what they produce because they aren't earning enough money and they don't have a social safety net, so they have to save. Their savings rate is so high. So demand is lower in that domestic economy, and there's been a lot of talk. They've been trying really hard to change that, and the best way to change that is with a really effective economic stimulus. And so they've tried a couple times. It hasn't quite taken off, but it seems they really seem to be pushing for something that is really going to have an impact on domestic consumption. And if they're able to be successful in that, that's really going to be a really strong factor for it's really going to drive their economic growth, but also world economic growth,
global growth, because now you got 1 point however many billion people. They're going to have a middle class. They're going to they're going to spend, they're going to go on trips, they're going to buy luxury handbags, they're going to whatever, right?
Exactly. And some of that trade surplus that's happening right now, that's building up their reserves, some of that's going to go into imports. And, all of the countries that are exporting to China, that's going to stimulate their economy too.
Yeah. Okay. So I did want to touch on that. We do have a question here on crypto. I will address it just because, whatever, we don't shy from anything here. You could ask anything on here. Thoughts on crypto? Do you see it fitting into the new North American political landscape? So our thoughts on crypto have kind of been the same for a while. For an investor that has a significantly high tolerance for risk, understands, appreciates it, and wants to own it, we can fit it on a small level in their portfolio as an asset class, knowing that it might very well go to zero at some point. But for most of our clients, it's not necessary to own it as an asset class. So do you see it having more of a fit? I do think this is just an opinion, and it's not more than anything based on just what I'm seeing in the mutual funds and the ETFs and the institutional buying. But I think there's a bit of a runway for crypto here in this cycle, but it could go to zero at some point, right? Like we really don't know with crypto. So I think I've said that before. I'm not bearish on crypto. I'm not bullish on crypto. I know it exists. I think there's more and more appetite for it, which could lead to more buying, but it is what is it called again? Fool's, what's the word I'm looking for? What's the expression I'm looking for?
Is it
the greater fool?
theory?
Yeah, it's the greater fool theory, right?
theory?
Someone's got to pay you more for this unit of crypto at some point in the future for you to make money. When we own a stock that spits out $2.49 of earnings in the last quarter, we know we made $2.49 of earning. If ever the stock falls down, we know earnings back the valuation, right? When we own an alternative asset class that is real estate or farmland or infrastructure, we know that every month there's a collection of rent or I guess a usage fee of some sort to use that asset. So we know we're collecting real dollars for our clients. With crypto, we don't know that. So it is purely speculating. You are speculating and hoping that someone will pay you more at a future date for the asset than you are today. And that might very well happen.
Yeah, it's a tough thing to evaluate, right? Because like you said, that crypto it doesn't really have any fundamentals, right? Like the fundamentals of a business or its revenue, its ability to generate profits, and you can evaluate the business based on that. With crypto, it's really, there's nothing to evaluate it. And the only source of return is selling it to somebody else for higher. So,
yeah, it's tough. We're not saying we're anti-crypto or pro-crypto. We are asset allocators. So if it makes sense for you to fit in your portfolio based on what we know about you, we would consider adding it in a small portion to your portfolio.
Yeah, exactly. I don't want to badmouth it because people have done really well with it. But it's important, back to diversification, but it can be one of the sources of return, but just don't overdo it.
And we're stewards of your wealth. So we have to protect you from you sometimes, right? I want to ask, or maybe I would just want to, did I miss anything in the slides here? I think I got productivity. Yeah, I think I got most of the stuff that we want to cover in the slides. I think I want to just maybe talk big picture here. Big picture with you for a little bit.
Yeah.
So yes, we are in a time of uncertainty for sure. I didn't feel this uncertainty, a year ago. We were very bullish a year ago, even 2 years ago. We've been for a while. We've been saying that we're in a 4-year market cycle, and we're kind of towards the middle of that. And our kind of target point for the end of the market cycle might be like late next year or maybe the year after. So we still thought, I still think that there's money to be made in this market cycle. This has thrown a bit of a wrench in that, right? This Trump, I'll just say Trump has thrown a bit of a wrench into that. So what do we do? So our job on a daily basis, we review the analysts, we look at the holdings that our clients have, we look at, the earnings, the profit, how they're doing. And that's our job, is to build that. And this is the most important thing that's on our mind on a day-to-day basis right now. We have an investment committee here at the Tetrault Group. We work together to see if we want to add new investments or remove some from our clients' portfolios. And that's what we do. So we take this very, very seriously. We're not trying to downplay it. We're not trying to say, stick your head in the sand and forget about it. That's not what we're trying to say here. we are trying to say that we're managing this. We might need to reduce some of your, asset allocation if it's a serious fear. We talked about that, but we're managing your money. Like, we're doing it on a day-to-day basis, right? And your options are right now, it's like, okay, what could I do with my cash if I'm, well, your options are somewhat limited. You can't sell everything and go to cash because you're not gonna get real returns, right? You're not gonna meet your retirement needs. You're not gonna. So I'm convinced that no matter what happens in the long run, there will be significant positive returns for stocks, for the fixed income, and for the alts. The way we manage money, and our clients will be great. Short term, guys, it's possible that we see volatility. It's possible. Valuations are somewhat stretched. We are looking at maybe trimming some of our, Mag 7 exposure, stuff like that we look at on a regular basis. We like that you own alternatives as a client. We like that you own some fixed income, a little bit maybe. And we're not going to panic and freak out and sell a whole bunch of stocks just because it's not what we do. So we like what you own today. So if you're asking me, hey, is anyone looking at my portfolio today? Is yes, we look at your portfolio. Yes, we know what you own. Yes, we're thinking about it every day. And yes, we are managing it with the intentions of protecting your capital and growing it. So does that mean, something might happen and catch us off guard? It's possible. It always does. The stock market does that, right? It hits you on the side of the head when what does Mike Tyson say? Everyone thinks they have a plan until they get punched in the mouth. Yeah. But we do have a plan for you. So, I'm not trying to preach here. I'm just trying to remind clients what we do here, right?
Yeah. And, you brought up a good point with diversification again, but with interest rates being higher, there are a lot of opportunities in bonds. I feel like I love bonds. I feel like I'm the one who's always trying
boring. No, yeah. I'm kidding.
We work with some great bond managers. So, and they've been out of favor with interest rates for so low for so long. I can understand why people would say boring. But there's some interesting strategies that they can diversify your portfolio and give you some very, lower but steadier returns.
No, I that was 100% joke because they serve a very real and very important purpose, right? Reducing volatility, predictable cash flow, and potential for upside depending on a tiny bit of upside in some certain situations. But just removing volatility from a portfolio, it's pretty good, right? It's pretty nice to know that if the market falls 20%, you're only going to fall 8 or 7.
Yeah, and the returns that were 3% probably over the last decade now in this market are probably going to be 6 or 7, 7%. So
in our private debt offerings and in our fixed income and in our anything that's kind of fixed income, that's kind of the range where we've been getting, right? 5, 6, 7, depending on the asset class inside of that guaranteed space. Private debt, you can get 6, 7. There's some alternative fixed income managers that we use that are 5.5, 6. Traditional bonds, you're getting 4.5, 5. So those are decent returns, especially in a registered account where you don't have to worry about tax.
Yeah, for sure.
There's something to be said about.
Yeah, the credit strategies have been close to the high single digits, almost close to 10%. So
8, 9% we're getting with our kind of alternative private credit. Yeah, so that there definitely is a place in a portfolio for locking in a portion of returns, predictable cash flow, knowing that you're not going to get hammered if there's a global trade war or whatever. There's a piece that it makes sense for pretty much everyone to own a sleeve of that. Question from Cal here. I'm going to show this one. It's about real estate. He's asking any comment on where you see real estate housing go over the next few years. So I believe he's asking private, I shouldn't say private, but multifamily. Well, those are two different things. Housing and then multifamily housing are two different things. I'll let you chat on, then I can give my opinion later, or do you want me to start?
No, I can start. Housing, real estate in Canada has done, extremely well, obviously, over the last little while. But, it is, the market, you have to segment it into the, different types of housing and real estate. So, multifamily has done really well over the last few years, while housing kind of slowed down a bit. But, I think Toronto and Vancouver, the Toronto and Vancouver housing markets, they are quite expensive and they probably won't perform, as strongly over the next 10 years as they did over the last 10 years. But other regional markets, Calgary's doing really well. Parts of the Maritimes, Halifax are doing really well in housing, and they could perform strongly if interest rates come back a little bit. And then also there's going to be multifamily demand. We do have a shortage of housing in Canada.
Huge shortage.
So, I think there's going to be strength in multifamily housing, even with this sort of temporary pullback in immigration that we're seeing. I think that asset's going to continue to perform well.
Yeah, there's going to be upward pressure on rents, and that they're going to capture that inflation. And there's no doubt that if you're in a private, in my opinion, if you're in a private multifamily REIT in your portfolio, if you see one that we've invested in, we're very bullish on the next 3 to 5 years in that area because of the reasons we mentioned. So would I rather own a stock that's a growth stock, or would I rather own a piece of multifamily real estate? I'll say I'd want to own both, and I'd want to be diversified. Definitely is what I would say. We're getting close to our end here. So I do want to respect your time, Adam, and our viewers' time. I'm going to ask if you have any further comments. If not, I'm going to ask you for your prediction on the Stanley Cup.
No major comments, just, interesting times we're going through. I am following this stuff really closely. So if anybody, has any questions about their portfolio, feel free to shoot me an email and ask me a question. Happy to chime in and help any way I can. As far as the Stanley Cup,
800 emails in your inbox.
As far as the Stanley Cup, I think might sound a little bit, I'm going to avoid emotion and stick to the facts. And I'm going to go with the first place overall team, the Winnipeg Jets.
Well, I think that's emotion, Adam.
No,
I think you're
pure stats, like pure data. It's all data.
Okay, so I'm a diehard Jets fan, but I'm going to go not off the board here, but I think this year Winnipeg hasn't had their hearts broken yet, right? Like they need to have their hearts broken in the conference finals or in the finals. I believe this is the year that Connor McDavid hoists the trophy. I watched that Amazon special on that guy is a leader, and he scored the goal yesterday, and he's just, man, they got goaltending, they got they got the two of the best players on the planet. This is the year that Connor McDavid lifts the trophy.
Well, at least we're both picking Canadian teams. This is the year it's going to come back to Canada.
Could you imagine picking like Boston or Florida or something? I think Florida's going to win it again this year. No, we're definitely not doing that. Okay, so we'll wrap that up. We want to thank you guys for tuning in. The call to action for you guys is if you're worried about your asset allocation, if you're up at night, then you need to reach out. Maybe we look at your plan, maybe we look at your portfolio. But otherwise, we got this. We are managing your portfolio, and we will protect your capital here. We're doing the absolute best we can. You are diversified. You don't own 100% stocks. So we're there for you, and we appreciate you, and we thank you for taking the time today. So thank you guys. Go Canada, go. Have a great weekend, and I will close it on that.